Hello, I'm James Leichter, and I'm going to explain how paying overtime can be very profitable. I'll explain why in about 4 minutes, so get comfortable. Paying overtime can be profitable. The key is, are you paying for billable time or unbillable time? When you're billing somebody, you're typically profitable even if you pay overtime. And I don't care if it's time and a half or double time, your company is typically still making a very good net profit. Let's first talk about production time. How many days or hours do we have available to sell? If you have 1,920 hours available to sell and you can only sell them Monday through Friday from 8 to 5, you're limiting your opportunity to reduce unbillable time and increase the amount of hours that you can sell to your customer. That's the key here. Let's review a simplified income statement. $1 million in sales or revenue. Costs of goods sold. We have material, equipment, subcontractors, and other direct expenses called MISO. Let's say it's $350,000, and we have $250,000 in direct labor costs. The total cost of goods sold, $600,000. So our cost of goods sold is 60%. Our gross profit is $400,000 or 40%. We have a gross profit margin of 40%. We take those gross profit dollars and pay our overhead. We want to think of overhead as variable overhead and fixed overhead. In this example, we have variable overhead of $50,000 or 5% of sales. We have fixed overhead of $300,000. Whatever's left over is, of course, net profit before income taxes. In this case, we'll say it's $50,000 or 5%. The key to understanding the profitability of overtime is understanding that when you priced your hourly labor rate, you were factoring in Monday through Friday, 8 to 5, roughly 1,920 available hours. Anything that you can do to open up that window, the Monday through Friday, 8 to 5 window, is profitable. And the reason is because your fixed overhead doesn't care about you working at night or working on a weekend. Fixed overhead is fixed. It won't change. So you do not have that expense when you're running a service call at 8 p.m. The only thing you have is cost of goods sold and variable overhead. And variable overhead is typically a very small amount of your overhead. For extra credit, I want to explain contribution margin, the little asterisk down here. Contribution margin is your gross profit dollars reduced by your variable overhead. Whatever's left over is called contribution dollars or contribution margin. You use those dollars to pay your fixed overhead. Once your fixed overhead has been paid, you are truly operating at break even. Your company is break even, and everything after that is very profitable because your fixed overhead has been paid. That's the key to this. Let's take a look at an example. Let's consider this service call example. Fixed overhead in this case is 0 because this is an overtime service call. It's performed after normal business hours, so it doesn't pay fixed overhead. Therefore, the net profit is $550. Now, considering that it was performed after hours or on the weekend, we might have to pay overtime. Not a problem. You can see that you can easily afford the overtime. Now, even if we pay double time, it's $200 instead of $100. Our cost of goods sold goes up $100. Our gross profit goes down $100. Our variable overhead changes slightly. Our net profit becomes $450 or 45%. I would gladly take a 45% net profit even if I paid double time. And that's why your company can easily afford to pay overtime. I'm James Leichter, founding president of Aptora. If you're interested in material like this, please subscribe, hit the like button. Be sure to hit the links below for more information, and I'll see you in the next video.